Breaking news coming out of Bloomberg just 1 hour as of this recording. First Republic Bank is said to weigh options, including a sale. I've obviously included Tannor into this video because he's been putting out crazy amounts of content around Silicon Valley Bank, Signature Bank closing, around First Republic Bank. And in this video, we're going to be talking about how First Republic Bank is looking to get acquired. Let's start, Tannor, at First Republic Bank. It was recently, just earlier today, downgraded to junk bond status by both S&P Global Ratings as well as Fitch Ratings, but a lot of it is backlash from Silicon Valley Bank. A lot of it is fears the bank has a lack of liquidity. Obviously, larger banks are going to show interest in buying First Republic. First Republic has over $70 billion in unused liquidity to fund operations. I want to get your take on, first of all, the junk bond rating status, because that actually had a pretty big effect on the stock. The stock was down about 21% today, which is ridiculous. S&P cut it from A+ status to BB+, which is considered junk classification, meaning that it is not investment grade. Fitch, even worse, from A to BB. You know, by contrast, I just want to include this there. It might not be perfectly applicable, but SOFI has a AAA rating by DBRS Morningstar for their ABS deal in 2022. So let's just first start there, and then we can move on to the more recent news around FRC looking to get acquired.
Thanks, Tevis. I mean, you said a lot of great things. You covered it very well. So we have to understand why they're even being downgraded in the first place. They're being downgraded because they believe, like what happened with Silicon Valley Bank, is that once this bank actually runs into liquidity issues and could potentially get shut down, not only is the management team wiped out, the equity holders wiped out, but so are the debt holders. The actual risk that you're not actually making your money back on these bonds is absolutely getting increased, even though we haven't seen direct signs from First Republic Bank and probably next to some of these companies like Western Alliance or something along these lines. The idea is that it's just getting risky. Once we started seeing Silicon Valley Bank, then Signature Bank, and so on, these other ones start to get downgraded. And the problem with being downgraded is that now, if they actually do need to borrow more capital, their actual rates at which they have to borrow at are much higher. Even if they were having a bunch of pressures before, this downgrade makes it even harder for them to survive going forward.
So it's actually going to hurt them in the case of a sale, which makes it even more surprising that news came out after the market closed that they're exploring a sale, because they're exploring a sale literally the same day that they got downgraded by multiple agencies, which obviously, just even logically speaking, would lower their par value in the market from potential acquirers. One of the first questions I had was, why would they be exploring a sale? Because a sale, especially after these downgrades, it signals a lot of fear into the market. FRC has been on this roller coaster over the last couple of days. They actually fell 62% on Monday. Everybody was scared about SVIB going into the weekend. FRC took the brunt of that hit on Monday. Their executive chairman went on CNBC. He basically said the bank is not seeing big outflows and in fact is operating as usual. An analyst from Raymond James on Monday also added that not only did outflows not accelerate, but they've been seeing net inflows from Signature Bank and from Silicon Valley Bank. If management is coming out trying to stop the bleeding of the stock and signaling that, hey, in fact, we are benefactors of these other banks collapsing, 2 days after that, ratings agencies, clearly not believing them, downgraded them. And after the market closed, now they're seeking a sale. Something is not adding up here. Why are they exploring a sale? Is it just BS, essentially, that the exec chairman is basically saying, we're fine? What's the take?
It could be because, like I said, margin pressures are a big deal, right? If they are getting downgraded and the likes of JP Morgan and all of these other clients that are also seeing inflows, Bank of America said they saw something along the lines of $15 billion from Silicon Valley Bank going down. Those companies are not getting downgraded. So their actual margin issues are going to be very different than the competitors. Another big issue is that shareholders are probably screaming at First Republic Bank saying, if this company is about to go down, I want at least a return on my money. How about we actually explore a sale just so that we can get something rather than nothing? They are kind of the next company on the chopping block. The stock, I mean, for a long-term holder has been a nightmare. For swing traders has been great. I'm sure Bill Ackman has made a fortune. I'm sure for the actual long-term people, the people that are actually sitting on the board, they are wanting out. They're sick of the stress. You know, they have massive amounts of capital tied up in this bank, and that they could just be thinking, this is just a little bit too much. We don't want to see another 2008 situation here where we're seeing massive runs on the bank. Yes, the depositors are safe, but that doesn't mean that people aren't still panicking. I don't know if the news is quite as widespread as people think. Clients are still moving money.
Right, and let's not forget, federal regulators over the weekend are trying to stop what's seeming to be a wider contagion in the banking system. One of the ways that they're trying to do that is something that you've been talking quite a bit about, the Bank Term Funding Program, which will allow banks to exchange high quality assets for cash without booking mark-to-market losses, which we're probably going to talk about more in depth as a mid to long-term solution. But for FRC right now, it's clear, at least to me, that the market isn't buying, from a PR perspective, what they're putting out there. What benefit does this have to somebody like a JP Morgan? I know that's a name that's been floated around, one of the biggest banks out there. JP Morgan, if they were to buy First Republic Bank, they would have to cover all the liquidity issues. It seems like it comes with mismanagement, it comes with a lot of headache, and especially after coming after the downgrades, they're not going to be in a position of leverage to sell those assets out. So what benefit is First Republic for a potential acquirer?
First Republic definitely, after getting downgraded, does not have the advantage here. It's the JP Morgans that have the advantage now. You guys have gotten downgraded. Who else but us is going to step up? Let's say they were to just go in and buy the entire company, take all of the assets. That rating of double Bs absolutely goes away. It's in the hands of JP Morgan now, which is very strong. Just by JP Morgan having it under their control, it instantly gets up boosted because they can actually provide the liquidity. In terms of the actual buyer, this could be amazing, right? This could get solved very quickly because the buyer has all the control here. For First Republic Bank, I just think they have no option. They're between a rock and a hard place. It's from a place of survival. It really doesn't matter what rate they sort of get. It's a matter of the buyer, of how cheap they can actually get this entire company, and then how much they can actually turn that around and increase the value of those assets.
To summarize, for First Republic Bank, a sale like this could be something like chopping off the limb to save the body, taking whatever they can get to salvage this essentially failing company. And for a potential buyer, they're getting it super cheap, and the return on the other's hand is going to be massively beneficial to them. Is that fairly correct to say?
Yeah, I don't think that this is a thing where management is trying to stay in place, right? This is not a company trying to survive. This is shareholders trying to get out. This is everyone going, you know what? If we all just sell against each other on public markets, we're all going to lose. Let's sell it all in one big block sale to some larger acquirer who might be pretty hungry right now. The way these banks work is they're kind of like frenemies in a way. They're all friends. They'll show up to the boards all together, but the second that one person actually starts to be a little bit injured, they turn on them like sharks,
Piranhas.
and it's absolutely a feeding frenzy. Yeah, exactly.
It's interesting that you mention it because, we talked about in the last SOFI Weekly podcast this scenario of potential acquisitions coming from a position of strength from the big players and a position of weakness from the smaller regional banks. One of the questions that I was interested in was what happens from a regulatory perspective. We talked about this last week in the weekly podcast. Chances are we're probably going to bring it up again as a potential topic. After reading into it a little bit, with JP Morgan as a use case, JP Morgan is among, if not the biggest, number one, from a market cap perspective, over $450 billion in market cap. Regulation and antitrust, those are two things that are going to be floated around regardless of what they're purchasing. Interestingly enough, from doing some reading, there's a Bank Holding Company Act of 1956 that specifically covers the regulation point. And what it states is it prohibits a bank holding company, in this case JP Morgan, from acquiring another bank if the resulting company, so the aggregate entity, both of them combined, would control more than 10% of the total deposits of insured banks in the United States. The limit can be increased to 15% under certain conditions. So really, from a regulation perspective, regulators' ears would only perk up if, let's say, JP Morgan was buying Citigroup or was buying Bank of America. But with JP Morgan really buying the smaller regional players, regulators are not going to be concerned about that. And then if it's not a regulatory issue, it becomes a potential antitrust issue. And from an antitrust perspective, the argument to be made there is whether JP Morgan is reducing competition in the industry by buying out something like a First Republic or one of these smaller players that might be in distress. Should they pass regulators, should they pass antitrust, then it's just a matter of capital requirements and the bank's actual balance sheets.
The only thing that makes me think whenever you were saying that is this one of those times where 15% is allowed? Because obviously the bank term funding program is there in case of emergency, but if they don't have to use it, they won't. I wonder if in the case of a JP Morgan, and I don't even know if they would be even close to 10% of depositors, but in that case, regardless, if they were to step past that with First Republic Bank, it would be allowed out or not. I think personally, if you actually compare, I was reading up today, in terms of assets under management, we are having more bank collapses just between the likes of Signature Bank, Silicon Valley Bank, and Silvergate, more than what was happening back in 2008. Now, you could factor in inflation and all of these things as well, but it's still insane of a statistic to know, and yet no one's really waving the red flag. If we start to get other names starting to drop, this could be a massive catastrophe, unlike what we've seen before. Different circumstances, but if regulation is there to allow a 15% to sort of allow the big players to step in and be the saving grace, I absolutely believe that button will be pressed.
Super quick lightning round. We mentioned JP Morgan as a potential name. What is another, blind shot in the dark on your end as to who could be a potential acquirer or interested party in First Republic? Like, who seems in a position of strength with enough capital and assets to be able to consume First Republic and benefit off of that weakness?
Honestly, what it's seeming like is, for the most part, none of these big banks are showing any sort of signs that they want to buy any of this stuff. Goldman Sachs has come out, JP Morgan has come out whenever Silicon Valley Bank was going down, and they were saying, we want no part of this. Obviously, they're looking for lower pricing. Well, First Republic even still has some legs underneath it. I don't even know if it will get a buyer. They'll need a very significant discount for this bank because JP Morgan, Goldman Sachs, Morgan Stanley, they have the time on their side. They can just wait them out. So that's sort of the funny part of that. So I don't know exactly who would even want to step in at this point or what sort of conversations are happening behind the scenes. So I don't know if there's actually a potential buyer even right now, but they're looking.
Right. Probably for the latest piece of news, we'll be covering it on SOFI Weekly, which is on Fridays at 10 p.m. Eastern. So make sure you tune in for that.